top three things in my notebook. Number one is the euro. Number two is the price of oil. And number three, it's global PMI day. On the euro, it's almost daily now that Draghi has to come out with a deflation and or fear-mongering, job-owning message to get the European central planners to engage in quantitative easing. Now, the reason he's doing this is, number one, he needs to ahead of January the 22nd, and number two, he doesn't yet have the German consensus on that. Do not confuse a policy to inflate with economic growth. Now, again, what's happened in Europe is more deflation, and again, he's very concerned about that. You can see it this morning. It's a very big problem, and again, it's something that hopefully you stayed on the right side of it with us in staying away from both the euro itself and European equities. Point number two is oil. This was the story into the back end of the year. Hopefully we're not long anything related to energies, stocks, commodities related to bonds, related to energy. But we're starting to see a narrowing of the risk range in the price of WTI oil. So this morning that level is 52.61 on the downside. So again, you're not getting a lot of downside in my risk range relative to what you had like 3 months ago, 6 months ago, et cetera. It's a leading indicator for lower level of volatility in the oil market. So it's something that I think you should pay attention to. In particular because the euro is oversold today. Now, why would that matter, euro versus oil? Well, because euro versus the dollar really matters versus oil. So again, final point this morning on the top three things is that the PMIs, if you call out the PMIs for the month of December, they're all slowing. China slowed a little bit and they make up the number. Spain slowed a little bit. The point is that both the absolute and the rate change in all the PMIs, don't forget that the U.S. PMI number, looking at the market PMI numbers, MARKIT kind, both slowed, both on the services and on the manufacturing side in December. Bond market, what does it have right? It has the growth is slowing in the fourth quarter versus the third quarter. And the narrative for Wall Street is going to be very difficult when they have to annualize the year-over-year GDP number for the U.S. It's going to be closer to 2 than 3, that's for sure. The bond market's got that right. That's why the 10-year bond yield